As the relentless march of inflation has battered economies worldwide, an unexpected plot twist has unfolded. The United Kingdom, once a laggard in the battle against runaway prices, has emerged as an unlikely victor, at least for now. In a role reversal that would make even Shakespeare blush, Britain finds itself with lower inflation than both the Eurozone and the United States, a feat not seen in over 2 years. This startling development is the product of a perfect storm of forces, with falling energy prices for consumers playing a starring role. As the regulatory cap on household energy bills plummeted by a staggering 12% last month, it unleashed a domino effect that sent Britain's rate of headline price growth into a tailspin. According to forecasters polled by Reuters, annual growth in consumer prices for April is predicted to drop to a modest 2.1% when official figures are released on Wednesday, a sharp contrast to March's 3.2% figure and a mere whisper away from the Bank of England's coveted 2% target. This dramatic downward shift in inflation has ignited a firestorm of debate among policymakers at the Bank of England, with some officials clamoring for an immediate reduction in interest rates from their 16-year high of 5.25%. The financial markets, ever the soothsayers of economic fortune, are pricing in the first rate cut as early as August. The international trend of the past 2 years will be turned on its head with inflation in the UK being lower than in the US and the Eurozone, declares Paul Dales, chief UK economist at Capital Economics, with the confidence of a seasoned oracle. This inflation forecast underpins our view that the bank will cut interest rates before the US Federal Reserve, perhaps in June, but if not, in August. For Prime Minister Rishi Sunak, this tantalizing prospect of slowing price growth could not have come at a more opportune time. Fresh on the heels of data this month revealing the UK economy's rebound from last year's recession, with growth of 0.6%, the fastest in 2 years, the Prime Minister can ill afford to squander this golden opportunity to bolster his political fortunes. Yet, even as the winds of change whisper sweet nothings of economic promise, the harsh reality remains that overall UK consumer prices have still surged by a staggering 22% since March 2021. This sobering fact has done little to temper Labour's relentless pursuit of electoral dominance, with the opposition party maintaining a consistent 20-point polling lead over the Tories. Across the Channel, the Eurozone and the United States find themselves grappling with their own inflationary demons, with respective rates of 2.4% and 3.4%. Consensus Economics, a company that distills the collective wisdom of leading economists, foresees the UK's inflation advantage persisting throughout the remainder of the year, as a resilient US economy threatens to prolong inflationary pressures and delay the Federal Reserve's first rate reduction. Amidst this global tug-of-war, the European Central Bank is expected to strike first, with economists anticipating an initial rate cut in June. The Bank of England, however, remains steadfastly focused on achieving sustainable 2% inflation, rather than merely flirting with the target before retreating into the shadows once more. Andrew Bailey, the bank's esteemed governor, has made it abundantly clear that the pivotal question lies in whether higher wages are being passed through to consumers. The latest data, he mused after the May meeting of the bank's Monetary Policy Committee, would tend to suggest it possibly isn't. As the world holds its collective breath, Britain's unexpected inflation triumph serves as a poignant reminder that the economic stage is ever shifting, with new protagonists and antagonists emerging from the wings with each passing act. In this grand drama of global finance, the only certainty is the uncertainty itself, a truth that both economists and laymen alike must embrace as they navigate the turbulent waters ahead.